What's up traders? If you're new to the channel, I'm a top author on the TradingView platform and I'm a swing trader as well as running an educational company in which I teach my students exactly how to trade with my strategies. In today's video, we will be speaking about EUR/USD. We'll be making a full breakdown and showing you how you're supposed to approach your trading from a multi-time frame perspective to actually understand and have an advantage in the market by using multi-time frame analysis and understanding what is going on to inevitably trade consistently if you can develop a strategy that is based on a multi-time frame analysis from the monthly to the 4-hour time frame. Without further ado, let's get in the video. Okay, so let's make some free analysis showing you guys how you can use multi-time frame analysis to understand what is going on in the market, and only in this way, by performing a multi-time frame analysis and understanding what is going on in the market from a different time frame perspective, you will be able to trade basically consistently in the long term, because you need a strategy and you need to understand how the market moves across the multiple time frames. So starting here from the weekly time frame, we just took a pair, okay, EUR/USD. I just want to show you what you're supposed to do when analyzing the market. So first thing, you need to concentrate now on this price action here. So what is going on in this? Basically in this, these are all weekly candles because obviously we are on the weekly time frame. And what is going on in this in months? What is being going on? So first of all, the first thing that you immediately recognize is that this is a very strong level for the market. Why do we say this? First of all, because you can clearly see that we have very strong support here. The market hit this level, rejected to the upside, hit this level again, rejected to the upside again. The market went for a retest of this level here and it acted obviously as resistance, then came from above, acted as support, and now that the market is coming from below, it will act as resistance. So what is the concept that we are applying in this particular case? The concept that we are applying is the concept of previous support to resistance, meaning that obviously if a market finds support at a level and then breaks that level to the downside, when the market goes back to retest that level that was previous support, obviously that level will act as resistance. And the same thing basically holds true for a market that it creates a level of resistance, then breaks it to the upside, and when the market will go back and retest that level, the market will find support at that level. Why? What is the underlying concept of this? Is that all the orders that were buy orders at this level, at that point will become sell orders, because basically the concept is that this is a strong area for the market, and it means that banks and big traders in the market, basically in the forex industry, are interested in this level. So if the market is coming from below, there will be buy orders. If the market is coming from above, there will be buy orders. If the market is coming from below, there will be sell orders. So here on a EUR/USD, okay, on the monthly chart, we clearly see that this is a very strong level. Another concept that we can take from here is that basically if we go down on the line chart, we can clearly see that we have two closes. Now when you go to a line chart, basically you get all of these angles. These angles are just closes in the market, specifically weekly closes, because we are on a weekly chart. And these weekly closes are extremely strong levels in the market. And you can see that in this particular case you have two weekly closes that are exactly at the same level, confirming that this is basically an extremely strong level for the market. Because as you know, wicks are not that important in the market. The important thing are the closes, and you can see that in this case they're almost at the exact same price, confirming that this is a very strong level for EUR/USD based on the weekly time frame. Now what happens if we go down on the daily? Now going down on the daily time frame, there is one thing that we immediately recognize, okay? I've been telling all of you on TradingView from the beginning of the week that basically on your USD we had this nice M formation, and after an M formation we're expecting a push to the neckline. Now the neckline of this M formation is exactly the same zone we had found on the weekly. For obvious reasons, it's exactly the same zone, and the neckline, in other words, is nothing else than the previous support that will be now turned resistance. So this is basically the situation that we have on Euro USD. Now, if the market will go for the retest of the neckline, we will also have created an internal, basically W formation, unless the market goes back down to complete this inverted head and shoulders and then go for a push, or basically to a push to the neckline. Now, as usual, trading is reactive and not predictive. So basically what we are waiting for with the students. First of all, we are waiting on the 4-hour time frame for all our conditions for entry to be satisfied for a push to the level we had already found. We already know that the market overall wants to go to retest the neckline, and we're waiting for one of our valid entries to take this long, because obviously we can't take a long from here because we don't have a good risk to reward. So we're waiting for a retracement, we're waiting for more conditions to be satisfied before we can enter this long position, possibly at the beginning of next week. Now, if we will not get our valid entry for the push to the upside, anyway, once the market will have made it to the neckline, we will definitely be monitoring price action inside of this area for the push to the downside, basically for the continuation to the downside, because what we want to see is impulse, correction, and impulse to the downside. And this is a very important pattern in the market that you see that it repeats over and over again. The most basic pattern in the market. You have the market moves in waves: impulse to the upside, retracement, impulse to the upside, retracement, or impulse to the upside, retracement. That is how the market moves. It is the intrinsic way in which the market moves. Impulses, corrections, impulses, corrections, impulses, then another minor correction, impulse, correction, impulse. That is how the market moves, okay? So we're waiting for this correction, and then if the market will correct inside of here, you see how my reasoning, okay? Every time I'm making an analysis is always if, then. It's never I want to see this happen. I always stay adaptive to how the market is evolving, okay? I'm always adaptive. I'm always, if the market will actually satisfy all my rules, then I'm able to take a trade, because at that point I have an advantage over the market. So basically what we're waiting specifically is the market to go inside of this region, as we already said, and then after the market, and if the market will go inside of the region, and if the market will clearly show us one of our valid entries, and before we can be looking for a valid entry, we clearly need to see the market shift from a bullish environment to a bearish environment, both from a structural perspective and from an environment perspective, then we can be looking for a short opportunity, and at that point we will have a very good risk to reward, basically at least a 1 to 3 for the potential push to the downside. So that is why I like to trade the impulses and not the retracements, okay? In this particular case, if I will get a valid entry, then I will take the long to the neckline if we will have at least a 1 to 3 risk to reward. At that point, after the market will have retraced to the neckline, we are, as I just said, we will definitely be looking for shorts if all of our conditions will be satisfied for the short position. So a couple of things that you can take from this analysis. First of all, always be looking for strong areas from a weekly perspective. It's extremely important that on the weekly you look at the market for a potential strong zones. Now in this particular case it was extremely simple. It's simple to see that we have support here, resistance here, support here, and that support will obviously become resistance. In this particular case it was extremely simple. So first concept that you need to take away from this is always look for strong areas. Second concept is you need to know the patterns that the market likes to complete. In this particular case on the daily it was extremely simple to see this M formation, and we know that after an M we expect a completion to the neckline. The third concept that you need to take from this is always react, never predict. If the market will make a retracement to this level, and if inside of this level we will see one of our valid entries on the 4-hour time frame, so we will see the market that starts shifting to the downside and provides us one of our valid entries, then we will be taking the trade, because the market could easily just go inside of this area and just keep impulsing to the upside without never giving us any kind of valid entry. In that particular case, obviously no trade will be given. So the thing that you really need to understand is you need to have a clear strategy, a clear set of rules that you can apply to know exactly when you're supposed to enter the market. And by doing this, so by knowing that you have a clear set of rules and applying those rules over and over and over again, you have already tested, both back tested and live tested, that those rules actually provide you consistent returns. And if you know that that strategy actually works, you will have no emotions in your trading and you will just keep applying your edge in the market over and over and over again. So if we will get to push to the zone, and if we will get a valid entry for the push to the downside with at least a 1 to 3 risk to reward, then definitely this is a trade that we will be taking with the students next week. If you enjoyed the video, make sure you smash the like button. It really does support the creation of more free analysis and, most importantly, education just like this. Also, make sure that you let me know in the comments below if you enjoyed the video and if you want to see more, because that also basically helps the creation of more free analysis and education just like this. Also, if you still haven't, make sure you go check out by clicking on the link below the mentorship program and everything that is included, because it's something that you won't find anywhere else. I answer all the questions of my students each and every day, as well as teaching them every day all my strategies, basically, and helping them each and every day after I train them on exactly all the rules. Every day I give you the market breakdown showing you how you're supposed to apply the strategies. So how to take the entries each and every day, stop losses, take profits each and every day directly on your student's dashboard. Looking forward to have you on the next video.